Pleased to bring to you Mr. Jinesh Gopani, Head of Equity at Axis Mutual Fund. Mr. Gopani holds over 16 years of experience in capital markets, of which 18 years are in equity fund management. He has to his credit an MMS in finance from Mumbai University. At Axis Mutual Fund, he currently manages the Axis Focus 25 Fund, Axis Long-Term Equity Fund, Axis Growth Opportunities Fund, Axis ESG Fund, and the newly launched Axis Healthcare Fund. He also co-manages many other equity-oriented schemes at the fund house. Mr. Gopani is known to have an eye for quality equity investing and has defined quality with robust investment processes and systems and follows a bottom-up approach to stock picking. Before joining Axis Mutual Fund, he worked with Birla Sun Life as a portfolio manager and with Voyager Capital as a senior research analyst. Mr. Gopani, thanks for joining. We'll discuss navigating the waves of COVID-19.
Yeah, pleasure to be on the call.
My first question to you is, when the novel coronavirus or COVID-19 cases were reported in Wuhan, China, towards the end of the calendar year 2019, did you envisage it spreading to the rest of the world, turning out to be a pandemic and causing havoc?
No, so see, frankly speaking, at that point of time, when things started getting murkier in China, it was not being envisaged to be spreading across the world. But as the reports started coming out, and fortunately, some of the companies where we are invested, they do have operations in China. And when we were talking to them on a general basis, we got to know that they have started closing down their China office and all sorts of things. So we got a bit worried, but frankly, it was to be fair to you, we never thought that it would be such a big pandemic across the world. But as you started getting more and more noise about what started happening in Italy, what started happening in the rest part of Europe, then obviously you could sense that something is really not going right. And that is where I think we took a call that we need to then talk to all the companies where we have invested and understand what they are hearing in the market. And clearly, some of the companies like specialty chemicals or the FMCG companies who have also MNC FMCG companies who have also operations in China and rest of Europe, clearly they gave us the indication that no, this is going to be a bigger issue. And ultimately it came to India as well. So I think by first week of March, it was certain that it is sort of a pandemic kind of a situation because it had hit Europe and some parts of US also. And then it came to India, if you remember. And by, I think if I'm correct, March 20th, last year we went under a complete lockdown.
Correct. Right. So I remember the first case was reported in Kerala in India, and the financial capital Mumbai was affected somewhere in mid-March. We had the first case. 2 weeks later, Prime Minister Modi announced a nationwide lockdown, and the equity markets tanked to a bottom of 25,981 on March 23rd, 2020. How did this impact your investments, and what were the risk management measures which you took to reduce the losses?
Correct. So if you really see before lockdown also, the 2 years prior, we had seen GDP coming down from 7.5 to 4.5, right? And you were around the new, you went into election also in that year, and then you had a budget before the lockdown set in. So obviously, the GDP was not as great as you should have seen. And hence things were any which ways to some extent slow. And fortunately for us, because we were waiting for a right opportunity to invest, we were sitting on a decent size of cash. But it was not a strategy, to be very frank. It was just that the GDP was also slowing down, and it had hit around, I think, if I'm correct, December GDP. December 20th GDP was around 4.5%, something like that. So we were just waiting for budget, if any clues we get. But unfortunately, by the time budget came and then pandemic hit, I think we were fortunate to sit on cash. So in the initial period, our take was just take out money from the high leverage sectors.
Right.
Fortunately for us, ex financials, we are into companies which are zero debt companies, mostly zero debt companies. So 60 to 70% of the portfolio, we never had that big impact, because see, at the end of the day, you cannot go zero, right?
Right.
So what we tried to do is like take out some money from the financials. So we took out 3 to 5% of the portfolio from the financials, and then went into technology and pharma,
Mhm.
while sitting on some amount of cash, because for me also, or for my team also, this is first time we are seeing this kind of an event, and how to react to that event. It was a learning,
Correct.
because nobody had seen 70 days of strict economic lockdown and economy coming to complete halt, and
Mhm.
how then the bounce back will come. So it was a very tough times, I should say, to understand the impact and then to come out of that impact.
Right.
So the initial was to just take out money, just go get into so-called defensives like pharma or technology, and just wait for things to get settled down.
Mhm.
But on the other side, frankly, the way economy bounced back after that was also not envisaged. That we always thought that it is going to be a slow movement in the economy, because people will lose jobs and all sorts of things. But fortunately, with government's effort on spending,
Mhm.
and also the rural economy not getting impacted that time, and we had a good monsoons and all sorts of things, the economy bounced back pretty nicely. And obviously, we were a bit late to understand that, however, how this revival will happen. And by December, we were like surprised that everything came to pre-COVID level. And again,
Right.
we never thought that we will move into second wave like this. So I
Correct.
think it is a very volatile journey. It's a very tough journey for us also to understand the impact, and understand what will happen. So our first thought process was, from a risk metric point of view, just ensure that the investors don't lose significant capital
Mhm.
from the portfolio. So we never had that problem, because our beta of the portfolios are lower than the market betas, and hence, or normally, if you see our performance, we do well when markets are on a flatter curve or the declining curve, because we always feel, from a risk adjusted return point of view, protection of capital and protection of return, both are very, very important. So you might
Right.
lose out in the momentum rally when it came, but on an average, if you take, we are okay, I should say.
I see. Okay. So we are back at about 0.4% on the GDP. Can you call this as a V-shaped recovery? Do you really call this as a V-shaped recovery and believe that this growth momentum will continue? Because we
Yeah,
are in a second wave now, and
right.
lockdowns have been imposed, and restrictions have been imposed in many states to
Yeah,
curb the infections.
yeah,
Which sectors and themes also you think will lag in the second wave of the pandemic, and which will come out to be winners when we
correct.
ultimately navigate the waves of the COVID-19 pandemic?
Correct. Yeah, yeah. Frankly speaking, I hope this time we have better understanding of this virus. We and hence, at least central government has not gone for a complete lockdown. However,
Mhm.
you don't know whether they will go for a national lockdown or no. As of now, the resistance has been that last year it was a very big. We almost, if I'm correct, we lost close to 250 to $260 billion of GDP when
Right.
we went into the lockdown. And at that time, it was needed, because we were not aware of the medicines to be used. We were not aware of vaccines availability. We were not aware of that virus itself, right?
Mhm.
Now that at least there is an understanding about how to protect the lives and the livelihoods. If it is just, let's say, 10-15 days of lockdown, and if we come under control, and I'm talking about, let's take an example of Maharashtra or Bombay, which went into this crisis again, I think March onwards this year. And now, if you see whatever numbers are coming, you are seeing at least some respite, as the administration has ramped up the healthcare facilities. So I think the learnings are there. Uh, Whether India can afford one more big national lockdown, I don't know, because government doesn't have that much money to pump prime like what a developed world would have done. And
Mhm.
also we are on a vaccination drive, right?
Right.
We can always say that we could have accelerated that drive, and the problem would have been lesser. But having said that, it's a large country, so you would appreciate how how the
Correct.
logistics and supply chain difficulties are. So I
Mhm.
think net, I would say if there are no national lockdowns, if there are intermittent local lockdowns, I think economy still 60-70% of the economy can continue to do their work. We have learnings. For example, when Bombay and Maharashtra went into lockdown, they did not stop the construction activity, right? They did not stop the essential activities. They did not stop the e-commerce activity to some extent, right?
Right.
So I think most of the activities are still going on. It is not a very strict lockdown, and people are able to do, let's say, 60-70% of the business what they are doing now, that many people are working from home. Now they've understood how to do business working from home. So I
Mhm.
think to that extent, the impact to the economy might not be terrible. Having said that, means I don't know how this virus will really take India. And means obviously uh, this time it is more of a super spreader kind of a thing,
Mhm.
where though the levels are low in terms of viral loads, but
Right.
it is impacting even the younger population. I think the only way out is to ensure that uh, you have a significant ramping up of vaccination, and to
Mhm.
ensure that things come under control by May end or even June. So that is what the understanding. If you take the example of UK, and if we are like UK, then by May end or June, that is what some of the experts says. Uh, we should see plateauing of cases and declining of cases, and I think Bombay is showing that signs.
So are you fearing a third wave? Because experts are now indicating a third wave. The number of cases is still over 35 lakh. And do you see this disrupting India's economic growth trajectory? And wealth creation in some form through equities can get disrupted. Which sectors and themes will
Yeah.
turn out to be winners?
Sorry, I forgot to talk about sectors. So clearly, if you really see, it is not going to be a straight curve. It is going to be an ups and downs kind of a situation.
Right.
Fortunately, having seen a massive second wave, we will learn from our mistakes, and we will improve our healthcare facilities much better in terms of availability of oxygen, availability of beds, availability of some of the key critical medicine. And hopefully for the third wave, we will be ready with massive healthcare facility, which
Mhm.
should, let's say, even if there is a third wave, we can manage it. I think, see, more important point is people are not dying because of COVID. People are dying because they are not getting proper treatment at right time.
Correct.
So if we are able to take care of that, and that is what US, Israel, and UK has shown, and by that time, let's say people are talking about third wave in October, September, something like that, and if we have a massive vaccination, as I said, by July, then I think things will be much better. If you take example of Israel, once they inoculated 30 to 40% of their population, the cases dropped dramatically.
Right.
Similar, now you are hearing same things in UK. In UK, by June 15th, I think they are talking of opening up the economy in a much better way. And yesterday there was one news which said that the third shot of vaccine will be available to UK citizens in December, and then it will be like a flu kind of a shot that every year or every 6 months you take this shot, so that the lethality or the severity of this virus, sorry, reduces significantly. So once you have that into play, and if there are no major deaths happening, then I think things will be much better. And now people have started to live with that. Right now there is a fear, right? So people who are not uh, doing simple things like wearing mask or social distancing, I think now people have realized, because they have seen. I think people getting infected in the family members, family relatives, or even among the friends. So this time, we should have learned from our first wave only, but whatever said and done, I think now the fear has come much more, and people will be more careful. I hope so.
Right.
So I think third wave, if managed well through healthcare facility, then shouldn't be any big issue.
So how do you view healthcare as a sector or pharma as a sector when it comes to an investment opportunity? Likewise, with people working from home and more emphasis on technology today, how are you seeing
Correct.
the tech sector as well?
So,
These two
so
themes for
yeah.
investments.
So to answer your earlier question, sorry, again I forgot about the sectors what you are betting on.
Yeah.
So clearly, see if let's say the impact to the economy is let's say only 1% or 1.5%, and still if we are looking at 10% kind of a GDP growth on a lower base for FY22, and hopefully once things are better, 23 and 24 could be 6-7% real GDP growth. Then clearly one sector which I should say good companies in that sector which should do well. If you are betting on the rebound of the economy, then financial is the best sector to play around. However, there will be intermittent volatilities you cannot shy away with because of the near-term lockdowns and all sorts of things. Second sector, what we are betting on is in technology. Clearly, technology is seeing a significant positive wave, I should say, in terms of the demand patterns and business patterns, and which can be seen even from the numbers they are coming out and the commentaries what they are talking about. Because clearly now many people or many corporates would have thought that I will digitize my business model in 3 year, 5 year time. They all have come on the drawing board and trying to spend as fast as possible because now it is the survival of the business. So
Right.
technology as a play looks pretty strong. On the export story side, even specialty chemicals are a good play to play around. And from the healthcare's perspective, see, frankly speaking, it's a very complex subject to understand. One company is big therapeutic segment in itself, and
Right.
there is lot of, I should say, volatility around US FDA, what kind of complex chemistries they are planning. So there is a lot of, I would say, regulations around which can lead to, let's say, sharp fall or sharp rise in the healthcare as a story. However, I like the concept, but just from a, if I have to play, let's say, for an export story between technology and pharma, then I would better play technology because that is more clean, more basket buying approach. Whereas in healthcare, in pharmaceutical, it is bit of a difficult game. Just to give you an example, and sorry to make it so long, yesterday US announced that they will go waive the IP rights or the patent rights for all the vaccination. And if you would have seen, Pfizer, Moderna, everywhere they were all down between 6 to 10%. So I think there is too much government intervention which comes into play in this sector because see, it's a social sector in that sense, right? And
Right.
any major profiteering then leads to problem. So I think just from that overall perspective, I would say technology is a better play, good companies, good cash flows, and obviously they also have a good runway of growth for next 2-3 years.
Right. Are you worried that we may see a sell-in may go away kind of a maxim coming through this summer? Because bond yields are somehow worrying the equity markets. They are impacting the equity markets. Do you see the enthusiasm for Indian equities reducing, or a sell-in may go away kind of a maxim coming true?
See, I think, we have already started underperforming the emerging market. If you see the data, we are underperforming by close to 10% odd. The Taiwan is up 20% YTD, Korea is up some 15% YTD, Hang Seng is up 10% YTD, and we would be around 3-4% kind of a thing. So clearly, YTD, we have already underperformed, and obviously, markets are way ahead of any individual person, and they sense it pretty fast than even before the numbers come out.
Right.
So they have already underperformed. I think the critical would be if it is just a 2 month issue, people are ready to give benefit of doubt. If we are able to contain this virus within 2.5 months time, but if it is a 6 month or a 9 month kind of a situation, then India will be a written off story in that sense. So as of now, why the question would be why markets are holding up and why markets are still ready to give that benefit of doubt, because if you see the companies uh, in top 10 in top 10 category, most of them are all blue chip companies and they have delivered exceptional performance even during this period. So if you take top 10, it is 62% of Nifty, right? So for them to not deliver doesn't look like, because they are still delivering in terms of numbers. So
Right.
markets have to go down only if we really screw up on the GDP front.
Right. But are
And
you
if
worried that,
that,
sorry,
yeah, sorry.
are you worried that valuations look a little frothy right now? The margin of safety has reduced for a portfolio construction point of view. Are you looking at that?
See, if you take historical data, then answer is yes. But I think the problem is the economics itself have changed. What we were taught in our MBA programs and what we are now seeing is totally different. Uh, People pump priming more to ensure that economy keeps on running, and still there is no inflation, right? So
Right.
there are concerns around inflation, but please understand, before equity markets get into a rout, bond markets will go into a rout if
Correct.
global interest rate starts rising beyond a point. Obviously, some rise is expected because of so much pump priming happening over last 1 year. Almost 20% of pump priming has happened over last 1 year than in last 10 years. So that is the amount of money sloshing around in the world, and so many bonds are at a negative interest rate. So I think if let's say for whatever reason US 10-year starts rising significantly, the impact to global debt will be much higher than compared to the equity market. Obviously, equity markets will also have to go through that massive pain. But so if it is calibrated, then I think, see, always we say that some inflation is always good. Some higher rates are always good for the economy, right? Because
Right.
that shows the strength of the economy. But if goes out of proportion, and anything going out of proportion, obviously you will have a massive consequence.
Correct. And that's
But
what exactly is
but
happening in the bond markets. The government borrowing is around 12 trillion for FY 2022. Our debt to
yeah,
GDP ratio is nearly 70%. It's proliferating, it's increasing, and the
yeah.
fiscal deficit is also widening. So these are the issues for the bond markets, and yields are getting impacted. The
Correct.
yield curve is
But
getting.
on the other side, please understand there is also a deflationary scenario,
Mhm.
right? And this is across the world. The likes of Amazons and the likes of other players have just ensured that the prices are kept low on the consumption basket,
Mhm.
while improving the supply chain logistics and making money out of inefficiencies, I should
Mhm.
say. Means improving that
Right.
inefficiency. So there has been a deflationary trend across the world in terms of prices.
Mhm.
However, as I said, that if let's say some inflation comes, it should be good for the equity markets, because that gives pricing power to the companies to price their product much better way. But let's say if there is an excessive inflation which goes out of control and which destructs the demand, then it is not a great sign.
Right.
So we'll have to see how really things unfold.
Mhm. Core inflation is looking a bit sticky. Input costs have also gone up for many industries. We are seeing
Yeah,
automobile companies also increasing the prices. Do
correct.
you see RBI's monetary policies accommodative stance turning somehow counterproductive at some point in time? Will policy rates go up?
See, at some point of time, given the fiscal deficit number, what we are talking about,
Mhm.
uh, they have to start inching up. But that is what I said, that if it is calibrated, and see, what market doesn't like is the uncertainty.
Right.
Suddenly you come and hike rates by 50, 70, 75 basis points, then it will be a shock to the market.
Mhm.
But let's say if you go give a gliding path saying that maybe after two monetary policies we will look to review, so that gets sink into the market, right? So people adjust the prices accordingly. Same thing happened if you really see what happened in US as well, right?
Mhm.
Once the Federal Reserve gave the gliding path, then the yields cooled off. But initially there was a question mark that new government has come, what will be their stance and what they are looking at and all sorts of things.
Mhm.
So I think market doesn't like uncertainties. And if markets are informed well in advance that this is what we are looking at, and we will tinker around accordingly, markets gets adjusted nicely.
Mm-hmm.
So I think interest rates are going to go up. When it goes up, I don't know. We are still in the pandemic area. So there would be some more time to ensure that businesses don't die down because of higher interest rates, higher working capital rates, and all sorts of things. Because then there will be a demand destruction. So I think they will go up, but maybe they will go up in Q4 or Q3. I don't know.
Okay, so how are you viewing the rate sensitive sectors? So the consumption theme, if we talk about the rate sensitive sectors, automobile, housing, how are you viewing this at the moment in this
No, I think
context?
see, once you have stability in the market, once you have in the economy, I think uh, we can show growth all across the sectors because there is huge pent up demand, there is huge penetration opportunity, and but we all forget the job creation, and
Mhm.
that is where the biggest problem lies. That everyone talks about penetration opportunity, everyone talks about huge India, 130 crore population, all sorts of things. But
Correct.
if you really see the per capita income improvement, in
Mhm.
fact, I was very surprised to see Bangladesh taking over India in terms of per capita. And you will
Mhm.
be surprised. I just heard from one of the experts only that why the per capita income in Bangladesh has gone up because the husband wife both are working.
Mhm.
Whereas in India, some data suggests that 40% of the urban women have dropped out from the workforce
Mhm.
for whatever reason. So unless and until you improve jobs, you create more jobs,
Mhm.
the per capita of the family will not improve. And that is the biggest, I would say, hindrance for our growth. If that is addressed over a period of time, then I think we have huge opportunity for all sorts of products to be sold in the market.
Right. Right. Another trend which we have been seeing in the mutual fund industry is that a lot of index funds have been launched. So are
Correct.
fund managers worried that they cannot generate alpha in this difficult times of COVID-19, or is active fund management losing its appeal?
Correct. No, I think a very fair question, relevant question, and this has been happening last 7 8 years in the developed world. So clearly, one is the cost structure, right? The cost
Mhm.
of getting into that product is far lower as compared to the active
Right.
funds. However, if you see, those markets are very developed markets, very sophisticated markets. The flow of information and everything is very sophisticated.
Mhm.
The liquidity is very much around. Whereas in Indian market, still you have price discovery, which is not great. Still you have illiquidity, which is not great, and still you have, I should say, many companies which are becoming part of Nifty and many companies coming out of Nifty, right? In
Correct.
terms of index stocks. So I would say obviously there is a role for ETFs as well,
Mhm.
but for active managers, it becomes more important to have a sharper focus on what they are trying to do and not index the product. Because then, if you want to just index the product, then obviously ETFs are more better play
Correct.
to play,
Correct.
and you would need more hard work. You will need to do more idea stock picking
Mhm.
to ensure that the active managers also play a good part in terms of giving returns to the shareholders. And also one more thing is, last 10 years, if you see the ETF world, they have not seen a massive fall in the market.
Mhm.
Dow Jones have been going up for last 10 years. And so it has been a one-way street, right? The true, I would say, the experience of ETF funds will be known only when there is a reverse as well.
Right.
uh, and that is where whether active fund managers are able to withstand the shocks and are able to outperform that time, or they also fall as like ETF funds. So that
Mhm.
is also going to be seen over a period of time. But obviously, with lot of liquidity around, as the cost structures are coming down, ETFs are also becoming a large part of everyone's portfolios, I should say.
Correct. The monthly data also suggests that index and ETFs have seen inflows over the last few months. So are you seeing some change in investor behavior that people are preferring some categories of funds? And typically in your case, at your fund house, what are the type of funds which have seen inflows and outflows?
See, fortunately for us, we are on a growing path. We are small as compared to others, and we have seen inflows given our base and given our track record of last 12 years. So, fortunately for us, we are seeing flows in both, I should say, active funds as well as passive funds. In fact, active fund flows are much more than the passive fund, given our performance. But our job also becomes much more tougher now, so we have to ensure that we live up to the expectation of the investor while outperforming the markets over a period of time. See,
Right.
obviously, every day you cannot outperform. You at least need to give 3 to 5 years for any fund manager or any scheme to really become mature and give you those kind of returns. So I think there are class of investors who are still ready to bet on the fund manager and the team what they have, or the institution where they are investing. However, there are class of investors who are now looking to invest into ETFs from a mutual fund investment point of view and trying to use their own brains to invest in the market directly, given so many options available now. So I think there are. I mean, see, market itself is huge, right? And there is huge opportunity given the way FD rates and everything has come down. The chance of making money has gone down significantly in the other instruments. So you will have, fortunately, I should say for us, still we have not seen outflows from one fund and inflows in other fund. We are gaining market share, and we are still very small in the overall scheme of.
So in general, what would be your advice to investors amidst this pandemic, and even otherwise? And how can they be more smart investors and make investing a habit so that it serves to be in their long-term financial well-being?
Correct. See, I think different investors will have different kind of risk appetite. So I don't know how your investors are really fitting in those brackets. But clearly, I think you should have everything, and depending on what is your risk appetite, what is the age profile of an investor. I think they should invest all across and try to maximize return, but don't take excessive risk. My humble request would be, don't get into that greed path that every day you are seeing markets going up and let me just catch everything today. You see, one is creating wealth is a long-term game. Making money is a short-term game.
Correct.
Right? It is like a cricket, right?
Right.
When you want to really see the uh, effort of the player and the record what he has, then Test cricket is the best way to look at in terms of the performances. Whereas if you want to make those quick bucks, then obviously there is T20 now available. So so clearly, I mean, depending on the risk appetite, I think one should really bifurcate its money into long-term wealth investments and playing around if at all they want. Ideally, I have seen making money for 2 3 years or 2 3 months, and then you start taking big bets and end up losing, and then you start saying it's like a casino market. Whereas on a long-term basis, if you understand the importance of compounding, the kind of wealth you will create over a period of, let's say, 5 10 years, it will be a shocker to you. In fact, in my uh, uh, experience also, I have seen so many of my family members holding those HUL or Castrol shares and have made, I mean, huge wealth out of it. And they would have bought, let's say, 1,000 shares, 2,000 shares for when 20 25 years back. And suddenly, when they wake up and see, means those lakhs have gone into crores. So, my point is, uh, uh, if you really want to create wealth at the time when you really need money, right? Uh, then I think long-term investment is very important. But if you are at a young age, you want to try out in the market, then obviously you have so many options.
Right. So my last question to you, which are the three books or blogs on investing you would recommend to our investors? so that they follow those blogs?
The first is which I like is and which I really see that is happening in the world is Fooled by Randomness by Nicholas Taleb. I think it's a great book to read, simple book to read, and you will see. And we have also experienced why we buy the stock and why we sell the stock. So there are so many events, so many instances happening around in the world, and you don't know what to do. Then I think the other book which I like is Range. It is a good book to understand how really people buy into the markets by David Epstein. Range. It's a great book to read. And the third one, if I may say, is which one? It is not a great book to really from the market point of view, but you will understand is Future Babel, and that is by Dan Gardner. Future Babel, where you will understand how economists go wrong every time. So, uh, see, these are the three very different books to go through. I mean, I don't know whether you will like it or no, but this is what I normally would recommend.
Right. All right, Mr. Gopani, thank you so much for speaking with PersonalFN, for your valuable inputs and time, and it was really wonderful speaking to you. I'm sure investors will immensely benefit from your views. Thank you so much.
Thank you, and it was a pleasure. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.